In today's 3-minute message, we continue our overview of accounting, a subject that all new business owners must understand. Let's get started.
The cash basis of accounting states that revenue is recognized when cash is received and expenses are recognized when cash is paid. The accrual basis of accounting states that revenue is recognized when it is earned and realized, not received, and expenses matches to the revenue in the period in which the revenue was earned and realized. This concept creates prepaid expenses, unearned revenues, expenses payable or accrued, and revenues receivable or accrued. Prepaid amounts are expense amounts that are recorded initially as an asset and are expensed in the future as they are matched to appropriate revenue. For example, rent paid ahead of time would be recorded as a debit to prepaid rent and a credit to cash. When the rent becomes due, the resulting entry would be a debit to rent expense and a credit to prepaid rent. Revenues are receipts that are recorded initially as a liability and then adjusted to revenue as the amount becomes earned. An example would be insurance premiums collected ahead of time by an insurance company, which would be a debit to cash and a credit to unearned premiums. When the premiums are earned, the resulting entry would be a debit to unearned premiums and a credit to premium revenue.
Payables are amounts owed to an entity that are expensed prior to the cash payment, such as a debit to wage expense and a credit to wages payable. When these amounts are paid, the debit is to wages payable and the credit is to cash. Receivables are assets that are created prior to the actual amount of revenue being received. For example, interest that has been earned but not yet received would be recorded as a debit to interest receivable and a credit to interest revenue. When the amount is collected, the journal entry would be a debit to cash and a credit to interest receivable. At year-end, prepaid expenses, unearned revenues, accrued payables, and accrued receivables are often adjusting entries journalized and then posted to the ledger. In addition to these items being adjusted, depreciation, depletion, and amortization expenses are part of year-end adjustments.
There are 4 major financial statements required to be filed with the Securities and Exchange Commission, SEC: the income statement, the statement of retained earnings or owner's capital, the balance sheet, and the statement of cash flows. We will discuss each in our next 3-minute message. If you like our videos, please subscribe and visit our YouTube, Instagram, and ERP Reimagined.com sites frequently. See you then.